Hey everyone, welcome back. I'm your friend in success, Robert Morris, and I'm here to talk to you today about realistically, consistently, which is important. Consistency in money is important, right? Earning 60 to 72% a year, day on the Rob Review. Let's get to it. The idea of doing this is not really so incredibly awe-inspiring unless I tell you that I'm doing it without risky day trading strategies. Doesn't mean I don't trade options, but I really don't trade intraday. Doesn't mean that people that don't do it don't make a lot of money. But the idea of this whole piece is to drill down into the fact that you don't need get rich quick. You don't need some long shot business to make yourself into a wealthy person eventually. Okay, I just got off this incredible interview with this woman named Crystal, and we talked about my experience in the MLM industry, specifically a particular MLM in my area that I believe just is all about get rich quick, all right? And I know a lot of people out there today are buying into these course after course gurus about get rich quick. Get rich quick is going to have you frustrated and broke for a long time. So let that die. Why? I'll give you an honest example. If you earn just 6% a month, compounded, okay, just 6% a month, compounded over 10 years, you will have over $7 million in an account. If you do that in an IRA specifically, you'll have over $7 million because I know and I've seen it done, because if you compound the money every single month, putting in more money than you did the month before, one, a lot of people will get to a vomit stage really quick that they can't stand, and you'll stop and start over. Or two, you'll just keep compounding. And even after the 10 years, imagine 20 years, 30 years, and people retire all the time without enough money to live on. If you're 20, 30, 40 watching this video and you start now, you can do it. Now, I'm not talking about doing risky things. I'm talking about something simple in the stock market, like buying and selling stock. Maybe you could start with as low as 6 or 7. Stocks right now are just really high priced. A lot of stocks aren't doing a lot of stock splits. So high priced stocks, buying in costs money, but there are low price stocks. And right below this video, there is a link to a website that I use to figure out low price stocks to buy without having to do a whole lot of my own research. Step 1 is stop thinking about get rich quick. Think about compounding a simple 6% a month return. Step 2, find stocks that you can buy a minimum of 200 shares and give a list of those right now, all right? What I mean by that is I'm going to give you a list of them right now, okay? Now that is going to be right here on the screen, right beside me, that if you're watching this video, I can pretty much tell you that I have done trades on these, or I know people that have, all right? So there's stocks that I wouldn't necessarily own for a long time, but for a year to do this strategy with, this is step 1, getting a low price stock that you can get in on. Anywhere from, I would consider low priced 20 to 30 all the way up to about $100. And then you need to be able to buy 200 shares of it, and I'll tell you why in a minute. Step 3, we're going to look at doing something called covered calls. Covered calls is when you own the stock and you're selling the call options on the stock that you own. It's a very simple strategy, and it can be explained in a lot of ways, but the simple way is that every stock has options listed on the stock exchange for a strike price, meaning if the stock is at 50, you're going to have, if the stock is a $5 strikes, you're going to have the 50, then the 55, then the 60, or the 50, then the 45, and so on, okay? Now, let's say if the stock was 50 and it was $1, okay? 50, 51, 52, 53, 50, 49, 48, and so on. Okay, so all those strike prices are where you can buy or sell the stock at and have an option to go with it or buy or sell the option. What we're doing with covered calls is simply saying we own 200 shares minimum of these stocks, and we want to make money off of the stock without selling it. How do you do that? Simple, covered calls. Why? Because you're covered because you own the stock. So you're going to take those and sell what I call one strike out of the money returns, okay? Out of the money is anything out of the current strike price. So if it's a $50 stock, again, out of the money is 51 and above. It's $5.55 and above. I do the out of the money because if you bought the stock at 50 and you're selling it above where you bought it at, there's a very, very low risk of this thing going wrong on you. And what you get when you sell it is called a premium. The call option on that stock has a bid and an ask price, okay? When you sell the call option, you get the bid price automatically put in your account times 100 share bundles. So let's say it's $2. You get $400 deposited into your account right then as a premium for agreeing to sell. That is step 3. Now, you're going to do this, step 4, 1 month of options, maybe 2. No weekly options yet, just 1 month. Why? Options are listed by the month or by the week, but if you do by the month, they expire on the 3rd Friday of every month. So as I'm recording this, we are in June. You could easily buy a stock, 200 shares, sell the July call options. They'll expire on the 3rd Friday of July, or you could still get away right now with selling, no, by the time I'm recording this and it releases, you got to do the July. So July, or you could do the August. Wait for it to either expire worthless and keep the premium, or if the stock exceeds the price you agreed upon by the 3rd Friday of the month, you're going to have to sell it probably. Because if you bought the stock for less than you have to sell it for, you make a profit there. Bottom line. That's why I do out of the money. If you bought the stock at 50 and you have to sell it for 55, because at, let's say you sold the July, 3rd Friday of July, the stock is getting ready to expire, or anytime before then, the stock gets above 55, let's say 60, 65, somebody, the person that bought your option, can exercise it. If they exercise it, it means that you have agreed to sell them that stock, so you have to do it. The 200 shares of XYZ stock at $55 a share is leaving your account, but they have to pay you $55 a share times the 200 shares you own, and that's $5 a share profit from where you bought it at, maybe more depending on if you let it rise a little bit before you even thought about selling it. For those of you that stayed this long, I will give you a quick and simple way to change your life doing this. Now, I know that you're already thinking this strategy is changing my life. If I use it, I can see where I can start right now and start earning money on my money, which is what everybody wants to do. That's what all these gurus and courses creators, that's what they're talking about. And it's as simple as a strategy that's been around since options were a thing. A long time. Now, instead of buying stock, when you get a lot of money built up, you can buy indexes. I do this with the TQQs, which is an offset of the triple Qs, which is a NASDAQ 100 index, which means it basically mimics the movement of the market. So it's even less risky, in my opinion, than a stock because it is there to grow. If you go back and you look at a chart of the TQQs, anytime chopping up since 2022, it's been rising, right? In a bull market. It did tank in bear markets, but let's just imagine for the most part, you owned it for the long haul going back to the 90s. Look at a chart. It's been on an upward trend with a few down years. So your money over the long period would have seen a rise. But now don't just own it. Own about 2,500 shares of it at the current price, about $170,000, $180,000. That's doable with the strategy that I just taught you. And then instead of worrying about what stock to buy every month, you just sell covered calls, which you can do on the indexes, not every month, once a quarter, 4 times a year. you can generally find 20 to 25% returns on good calls that you're going to sell for 4 months. Now, understanding that you have to be very, very present of mind at what you're selling, because the TQQs can rise quickly and you can be called out. But as long as you sell above where you currently have value in it, what's the real shame in owning something and having to sell it for more, waiting for it to drop and buy back more?
The views and opinions expressed in this program or any other Rob Review program are not to be considered financial advice, and all these strategies have their own inherent risk. If you act on information given in this show, you are doing so at your own financial risk. Map.Productions does not take part in your positive or negative financial results. That is why I recommend you consult your financial advisor before acting on any of these tips. What worked for Robbie may not work for you exactly as shown in the show.